For the past few years, the world has been using more silver than it produces. Now, this isn't a theory, it's a math problem. And when you spend more than you earn long enough, eventually the savings runs out. Now in this video, I want to show you why that's happening with silver and why it matters more than most people realize.
For several years now, global silver demand is exceeding mine supply, similar to spending more money than you earn. To make up the difference, the market has relied on above-ground inventories, stored silver held in vaults around the world. Since 2021, that gap has added up to an estimated 800 million ounces. That's not a short-term shortage, that's a structural deficit. We've been funding today's demand by drawing down yesterday's savings. What makes it important is what happens next. Three powerful forces are now converging at the same time: shrinking inventories, exploding industrial demand, and a mining supply that can't respond quickly. For decades, the silver market had a safety net. When mining supplies fell short, large bullion stockpiles in London, New York, and Shanghai filled the gap. That safety net is now thinning. Since 2021, inventories tracked by the LBMA and the COMEX have fallen sharply, with the COMEX holding down roughly 70% of their 2020 peak. Shanghai inventories have dropped to their lowest levels in more than a decade. This isn't just accounting. Physical tightness has shown up in the real world through rising silver lease rates, the cost to borrow physical silver. When manufacturers struggle to source silver for electronics, solar panels, or vehicles, those higher costs eventually reach consumers.
This part matters because it affects everyone, not just investors.
Silver isn't just a luxury item or investment anymore. It's become a critical industrial material. One major driver is solar energy. Silver's unmatched conductivity makes it essential in solar panels, and their manufacturing now consumes close to a third of all industrial silver demand. That directly links silver's availability to the cost of energy infrastructure. Another major driver is solid-state batteries, particularly their use in electronic vehicles. Each has about a kilo of silver inside, and as demand for EVs increases and the adoption grows, silver demand grows with it. A third, fast-growing source is data centers and artificial intelligence. Silver is critical in servers, electrical contacts, and the power needed to run it all. As AI development accelerates, securing silver has moved beyond economics. Now it's a national security. That's one reason the US government officially classified silver as a critical mineral. When essential materials become scarce, competition between nations intensifies, increasing the risk of trade disputes and geopolitical strain. If silver demand were the only issue, the market could just adjust. The real constraint is supply. Over 70% of global silver is produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver output doesn't respond directly to silver prices. Even if silver prices rise sharply, miners can't increase production unless demand for those other metals also rises. Years of underinvestment have also left the industry with few discoveries and declining ore grades. New mines take 7 to 10 years to develop and face heavy regulatory hurdles. This creates an inelastic supply chain that struggles to respond to rapid demand growth.
Anytime price targets get mentioned, it's important to be clear. This isn't about predicting a number. It's about understanding pressure.
When inventories shrink, demand accelerates and supply can't respond. Price pressure becomes unavoidable. Some analysts have floated aggressive numbers, $100 or even $500 silver, but the real story isn't the target. It's the disconnect between financial pricing and physical availability. For years, silver traded comfortably on paper. Today, industrial users are increasingly focused on securing supply, not price optimization or trading. When physical shortages collide with financial markets, volatility tends to follow. For consumers, that doesn't mean silver investing. It means higher costs embedded in technology, energy, transportation, and infrastructure. Silver has reached a critical point. Stockpiles are shrinking, industrial demand is accelerating, and mining supply is constrained. This isn't just a temporary imbalance, it's a structural shift. The question is no longer if the market adjusts, but how and when. As nations compete for critical materials, the ripple effect will be felt far beyond precious metals.
If this video has helped you see the silver market more clearly, feel free to like and subscribe. Thanks for watching.